In the third quarter of 2025, something quietly seismic happened. Chinese billionaires sold $47.2 billion of U.S. equities and moved almost the exact same amount into physical gold, bars, ETFs, and private vault storage across Hong Kong, Singapore, and Switzerland. On the surface, it looks like routine portfolio rebalancing. But this mirrors the exact pattern that preceded the 2007-2009 crash, when early capital flight helped signal a collapse that erased trillions in U.S. wealth. The data is stark. After a net plus $23 billion of Chinese buying in Q3 2024, the shift to minus $47 billion in Q3 2025 is a $70 billion swing in sentiment in 12 months. Unprecedented given 4 decades of steady Chinese accumulation of U.S. assets since Deng Xiaoping opened the economy in 1978. This isn't retail demand for jewelry. The World Gold Council breakdown shows $28.3 billion in physical purchases, $12.6 billion into institutional allocations/ETFs, and $6.3 billion into private vaults, dollar for dollar with the equities sold. High-profile names reduced or exited U.S. positions and directed proceeds into gold, signaling a coordinated, information-driven move by ultra-wealthy actors who see risks ordinary investors do not. Why would they do this? History and information asymmetry explain it. In 2006-2007, Chinese capital flows turned net negative months before the global crisis because Chinese owners of factories, banks, and trading networks observed demand slow, saw credit deteriorate, and had banking counterparty visibility into toxic mortgage exposures well before lagging U.S. data did. The same feedback loops are at work now. Chinese manufacturers making servers, chips, and AI infrastructure reported order declines in Q3 2025. Chip orders for AI gear fell sharply, signaling weaker demand ahead of corporate earnings. Billionaires who own factories and have real-time manufacturing and shipping intelligence saw order cancellations before they showed up in quarterly earnings, and they reacted. They also worry about macro risks. U.S. sovereign debt is large and growing. Geopolitical freeze or seize precedents, example, frozen Russian assets, raise legal risk for foreign holders. And the dollar share of global reserves is declining, all factors that make dollar-denominated assets less attractive. Moving wealth into physical gold stored in non-U.S. vaults both preserves purchasing power and reduces seizure risk. Gold itself is a logical refuge. No counterparty risk, global acceptance, and a long track record preserving real purchasing power through currency crises. Central banks are also buyers. Q3 saw record quarterly central bank purchases, which creates a structural bid underpriced as supply from mines remains flat. The pattern of capital flight typically unfolds in 3 waves. Wave 1, smart money. The quiet, early exits by billionaires and family offices, what we are in now. Wave 2, institutions. Forced selling by funds, pensions, and leveraged vehicles as the market cracks, creating the crash. Wave 3, retail panic, mass redemptions and capitulation where ordinary investors sell low. In 2007, the initial Chinese selling was invisible to most U.S. retail investors, but preceded the freezing credit markets, the failure of major institutions, and a 57% S&P decline over 18 to 28 months. If the pattern repeats, the Chinese exodus in Q3 2025 implies a 12 to 18-month warning window, placing the highest risk of broader market collapse in Q1 to Q3 2026. What should investors do? The channel's repeated thesis is practical. Assess exposure and reduce concentrated bets in overvalued, hype-driven tech names tied to discretionary capital cycles, especially companies dependent on AI capex whose orders are already softening. Consider a defensive, diversified allocation. Meaningful cash to buy the bottom, a core gold position, physical or ETFs, high-quality defensive equities, some short-duration bonds for liquidity, and a small allocation to gold miners for upside leverage. If you hold physical gold, prefer reputable custody outside single points of geopolitical risk. If you hold crypto or offshore assets, consider custody and legal jurisdiction risk. The goal is not zero exposure to U.S. equities, but lowering asymmetric downside. Be able to sleep if stocks fall 30 to 50% and possess the dry powder to buy into the reset. The choice is yours.